Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Dave Ross. 419-794-3030 is the phone number. It's 419-794-3030. ARHQ.com is the website. If you missed the first half of the show or previous editions of the show, you want to catch up on topics, all available for you on demand, YouTube, Apple Podcasts, Spotify, wherever you consume your media. Just search for America's Retirement Headquarters. It's all there for you to check out whenever you're ready. One of the biggest questions asked on financial news networks lately is how high can the markets go before a major downturn? Here's investment officer Sylvia Yablonsky recently on CNBC.
I think we're due for a pullback. The markets are really melting up, but pullbacks are also opportunities to come into the market. You have $6 trillion sitting on the sidelines or sitting in those 5% money markets. The market's doing a lot better than that this year, 17% on an SPX, over 20% on NASDAQ. So I think pullbacks are only a good thing if you have cash on the sidelines. And if you're in it for the long run, just don't look at your account for those couple of days, stay the course. I think a pullback is healthy at this stage.
It kind of sounds to me like she's trying to time the market. Long-time listeners of the show will know your advice when it comes to timing the market. What are you telling clients right now that have a lot of cash on the sidelines?
Well, I think Sylvia talks a little bit about a pullback in the market, and what that means is investors getting statements that show their account values are going down and they're losing money. And I think nobody likes to see negatives on their statements. I totally get that, but I would agree that pullbacks are a normal part of the overall market. What you have to do is history doesn't always repeat itself, but it certainly is a indication of what could happen in the future. When we think of investing, it's pretty simple: buy low, sell high. The markets are close to or at record level highs. And, we've run into a lot of different people, and they're confused on what to do. They see these double-digit returns in the market, and, they're not keeping pace with inflation and taxes with their cash accounts. They're wondering what to do. The first thing I would say is it depends upon what is the goal, the intent, and the time frame on when you're going to want to use that money. The process that we've put together here at America's Retirement Headquarters is called the Independent Income System. That is our unique methodology and philosophy when it comes to how to diversify and invest your portfolio and figure out, things like how much should be in cash versus the market. If you haven't watched that video, I would encourage you, just go on Google, type in Independent Income System, and you can take a look at how that strategy works. Maybe that will help you, give you a little bit better of understanding how to position your portfolio moving forward throughout the economy. When we look at the markets and we're looking at, the specifics of where the markets are at, Sylvia talked a little bit about markets due for a pullback. You mentioned the word timing there. It is very difficult, I would say, to time the market. I do know with some of our strategies, like in our what's called Iron Retirement Series, what we do is we use what I would refer to as circuit breaker technology. And with circuit breaker technology, we're looking at, is the market technically moving in what we consider to be a positive direction, or is the market having a sell-off? And we have recently just raised where our level of protection is in our Iron Retirement Series, moving it up to closer to the moving averages of the market, trying to reduce some of the downside risk that's in the portfolio, trying to raise that level of protection. Now's a good time if you have a lot of market risk in your portfolio, understanding what your downside risk management program is, understanding what your exit strategies are in place. Another one of our portfolios that we have, which is called our King's portfolio, is in part of the portfolio we utilize what is referred to as buffered ETFs. And what a buffered ETF does is it allows you to participate up to a capped rate of return in an underlying index, being like, say, the S&P 500 index or some other index. And then if and when the market is negative, it allows you to put a percentage or some of those losses to another investor and help limit what those downside risks are. I met with a lady who recently had gotten divorced, and she came into the office, and this is kind of a whole new world for her. And instead of, say, like in a pool jumping in the deep end, she kind of wanted to wade into the water. Mm-hmm. And I think that makes sense. When you're thinking of wading into water, there's a strategy called dollar cost averaging. Dollar cost averaging means you can put a little bit of money in the market, maybe over a 12-month or 24-month time frame, so you're not putting it all in place. The other thing that she had asked me about some of the different annuity products that are out there. Annuities offer different types of protection. The more common one that we use here at our office is what is called a fixed annuity. We also utilize what is called an indexed annuity. A fixed annuity can be a place where you can keep your fixed income, your more conservative reserves, locking in some of the higher rates that are out there right now. The index annuities are the ones that allow you to participate when an underlying index goes up, but they have a floor in place that ultimately can protect you. Most of the ones are annual reset type features, meaning that on an annual basis, they're going to look at what the underlying market index does. If it goes up, you get to participate in some or all of that gain, depending upon what the strategy is. But if the underlying index goes down, you don't have to worry about taking losses in the market. And then last thing is I would say when you're looking at should you invest in the market is to know what you own. It's crucial to know what the investments are in the portfolio. We have, for our stock selection process, a very defined investment approach of looking at companies that we tend to like, which are cash rich, low debt, have a high profit margin, companies that are needed on a daily basis, and or have a competitive advantage. And if we could go back in time and you maybe got together and made an investment decision to put money in the market, let's say it was October of 2007, right before the major market crash of 2008, or even if you invested right before COVID, as long as you didn't panic and you understood what the time frame was, and you continued to weather through the storm, you're in much better shape today with looking at where the equity markets are in general. You just have to be, willing to tolerate that, which is why it's so important to know what you own. So the way that I see it is there's opportunities, markets that are at a high. You've got to be somewhat cautious. And again, it kind of goes back to your game plan. That's what I'm telling people. Dave, what about you?
I would say that we're definitely in an environment where if you pick quality and you look at the companies that are doing well, there are still opportunities. You look at the prices on some of the more widely held stocks, it's not uncommon to see stock prices that are $200, $400, $500 a share. And quite honestly, those prices kind of preclude a lot of people from owning them. So when you put together your investment plan, when a company splits, if it's a positive, a company is doing very well in the market, that's an opportunity to start buying in, or as Nolan would say, dollar cost average into that investment. I definitely think that having eyes on the market, which that's what we do, really points investors and our clients towards opportunities that exist in the market. Because you know what? It comes back to one very interesting thing. If we get out of the market, and right now, if you got out of the market, you could still earn 5% in high yield money market. But when do you get back in? And when Nolan talks about circuit breakers, if there's indicators that are showing that we might be headed toward an event and the circuit breakers kick in, some of that money goes into safety or goes into cash. When those indicators shift and they start showing signs of growth again, then the circuit breaker kicks and we go back into growth mode. So I think the investment philosophy that we have here at America's Retirement Headquarters really gives our clients the best of both worlds, where they can navigate what risk tolerance they have, but also they're working with people who are looking at the opportunities that present themselves and are willing to make a recommendation that will allow clients to profit from those opportunities.
Being able to look and see when those market downturns, being able to redeploy. Look, the growth potential that comes with the market can't be understated. Obviously, that is something to combat inflation, to generate, a higher balance down the line. can't deny the potential there. The risk that may come with it also can't be understated. So finding that right blend for you comes with a better understanding of what your risk tolerance is. And if you aren't fully aware, the team at America's Retirement Headquarters, they can help shine a light on that. And if you find out maybe you're overextended or maybe you're be comfortable with more risk, being able to pivot and make those changes, but you don't know until you sit down and you have that conversation with a team like America's Retirement Headquarters. 419-794-3030 is how you go about doing it. You can also go to the website, reach out there as well. It's arhq.com.